What if the single largest wealth destruction event in modern financial history wasn't an accident, but a meticulously planned operation? What if the catastrophic precious metals crash that vaporized $10 trillion in 6 hours followed a playbook that's been executed with chilling precision 3 times across 50 years? And what if every single move, from contradictory White House signals to a sudden Chinese retreat, was a coordinated piece of the same script? The evidence reveals this wasn't market volatility. This was a 72-hour financial demolition, and the target was not just your portfolio, but the very idea of real money outside their control. By the end of this, you will see every piece of the puzzle and understand why they are so desperate to keep it hidden. 72 hours, that is the definitive time frame that transformed the most explosive rally precious metals have ever witnessed into the most savage liquidation event ever recorded. 3 trading days, 3 strategic maneuvers, $10 trillion in global wealth systematically erased. Let us be unequivocal from the outset. What culminated on Friday, January 30th, 2026 was not a crash. The term crash implies chaos, accident, an uncontrollable market force. What occurred was an execution, a controlled demolition of wealth orchestrated with such strategic precision, such flawless timing, that its architecture reveals a reality far more calculated than any headline suggests. Gold collapsed 15%. Silver was gutted by 40%. This devastation unfolded not over weeks, but within a single 6-hour trading session. That morning the world was quiet. No new geopolitical conflict erupted. No global pandemic was declared, no major financial institution failed. The news wires were silent. Yet within that unsettling calm, $10 trillion simply ceased to exist. But this is the narrative they omitted. As digital portfolios bled out worldwide, a parallel crisis loomed in Washington, D.C. The United States government stood on the precipice of a total shutdown. A political storm provided the perfect backdrop for a financial hurricane. And positioned directly in the eye of both storms was the single largest one-day destruction of precious metals capital in human history. You believe this confluence of events was mere coincidence? Let us examine the script. I understand why you are here. You witnessed the collapse. Perhaps you held physical metal. Perhaps you held mining shares or ETFs. You saw years of patient accumulation of conviction seemingly obliterated in one afternoon without a coherent explanation from any mainstream financial authority. They told you it was a healthy correction. They told you markets had become overextended. They told you this was simply supply and demand. I am here to dismantle that fiction. This was not natural. This was not healthy. This was a screenplay drafted months in advance, rehearsed through incremental policy shifts, and performed with military-grade coordination across a precise 72-hour window. Today, I will walk you through that screenplay scene by scene, actor by actor, mechanism by mechanism. By the conclusion, you will know the who, the how, and the profound why. You will understand why this precise playbook has been activated twice before in the last half-century, and what that recurring pattern tells us about the true battle for financial sovereignty. Stay with me. Our chronology begins on Tuesday, January 27th, 2026. President Trump addresses the nation and the world. To most viewers, it is standard political discourse. Then he delivers a line that would reverberate through global trading desks. A weaker US dollar, he asserts, would be a powerful boon to American businesses. He suggests the United States should adopt the long-standing strategy of economic rivals, strategically devalue its currency to boost exports and enhance global competitiveness. To the public, this is abstract economic theory. To the financial elite in New York, London, and Hong Kong, it was a clarion call. The President of the United States had just publicly signaled a desire for dollar weakness. The immediate ironclad market logic is this. Precious metals are priced in US dollars globally. A weaker dollar means it takes more of those dollars to buy the same ounce of gold or silver. The trade was instant and unanimous. Hedge funds initiated massive short positions against the dollar. Asset managers ramped up gold allocations. A tidal wave of retail capital flooded into silver ETFs and futures. Billions of dollars moved in one synchronized direction, all betting on the same outcome: a declining dollar and skyrocketing metals. Tuesday was the day the narrative was set. It was also the day the trap was baited. No one rushing into the trade realized they were entering a pre-designed corridor. Now, advance to Thursday, January 29th. The scene is one of historic, dizzying euphoria. Gold achieves an unprecedented $5,600 per ounce. Silver shatters records, breaching 121. The numbers defied rationality. Silver had surged a staggering 68% in the month of January alone, marking its most powerful monthly advance since December of 1979. Social media financial channels were ablaze with predictions of $200, $300, even $500 silver. The iShares Silver Trust, SLV, reported a monumental $171 million single-day inflow from retail investors that Monday, the largest daily influx in the fund's entire history, doubling the prior record set during the 2021 silver squeeze frenzy. The total market capitalization of the silver complex had ballooned to approximately $6 trillion, a value surpassing corporate giants like Apple and Nvidia. One analyst, surveying the mania, dubbed silver the meme commodity of 2026. Portfolio statements showed gains of 50%, 100%, 200%. On Thursday night, investors retired with visions of generational wealth. None knew that in the quiet of the night, the final authorization for a counter-operation had been secured. Friday, January 30th, 6 a.m. Eastern Time, pre-market silence. Then a headline fractures the calm. President Trump announces his nominee for the next chair of the Federal Reserve, Kevin Warsh. To the general public, this is a bureaucratic footnote. To the professional trading community, it was a strategic detonation. Kevin Warsh is renowned in central banking circles as an archetypal hard money hawk. His entire career philosophy is built on a foundation of monetary restraint, stronger currency values, and combating inflation, the exact ideological opposite of the weak dollar policy hinted at just 72 hours earlier. Do you perceive the engineered contradiction? Tuesday, the executive branch signals dollar weakness, igniting a furious metals buying spree and dollar shorting. Friday, the same executive branch nominates a central banker whose core mandate would be dollar strength. The result was a forced violent reversal. Every trader who shorted the dollar on Tuesday was now compelled to buy it back. Every entity that bought metals on Tuesday was now forced to sell. This was not policy dissonance. This was a pincer movement. The trap set on Tuesday snapped shut on Friday. But the mechanics of a typical policy reversal could not explain a 40% collapse in silver. Such a move requires not just sellers, but the complete evaporation of buyers. This is where a third pivotal actor entered the stage: China. You must understand a fundamental axiom of the physical metals market. China is the globe's dominant consumer of silver, critical for its solar panel, electronics, and electric vehicle industries. Historically, during price dislocations, Chinese entities have stepped in as buyers of last resort, purchasing the dip and establishing a tangible price floor. This time, the script was different. At the precise moment of maximum panic, when global sellers desperately needed liquidity, the Shanghai Futures Exchange did something decisive. It raised margin requirements substantially and stepped back from the market. China, the habitual stabilizer, withdrew. The implication was catastrophic. American and European traders were forced to sell due to the Warsh nomination, but now, the one buyer historically guaranteed to absorb that selling pressure had vanished. A market with only sellers and zero buyers does not correct. It implodes. The algorithmic machines detected the liquidity vacuum instantly. A cascade of stop-loss orders triggered automatically. Margin calls flashed across brokerage platforms from Wall Street to Main Street. Traders who were massively leveraged, riding the euphoric rally, received liquidation notices en masse. The collapse became self-fulfilling. Silver plummeted from $121 through the critical $100 psychological barrier and into a free fall: 95, 90, 85, 80, 75s. $46 in value was erased in 6 hours. The ProShares Ultra Silver ETF, AGQ, a leveraged instrument, collapsed 60%. A $10,000 investment effectively became $4,000 between sunrise and sunset. Gold fell from its $5,600 pinnacle to $4,700, a loss of $900 per ounce. In total, approximately $3.4 trillion in gold valuation and over $6 trillion across the broader complex vanished. One veteran trading desk termed it a capitulation event of historic proportions. Another called it simply the single largest wealth destruction day in precious metals history. $10 trillion. One session. Now, we move past the headlines and into the forensic data. What the actual exchange records reveal changes the entire narrative. On that fateful Friday, a staggering 531 metric tons of silver futures contracts traded hands on the Shanghai Exchange. The surface reading suggests a tidal wave of physical selling. But here's the critical, undeniable fact. The amount of physical silver actually withdrawn from Shanghai Exchange vaults on Friday was 0. Not 1 ounce, not 1 gram. Let that resonate. 531 tons of paper contracts traded, 0 tons of physical metal moved. This reveals the true nature of the event. This was not a mass exodus from physical metal. This was a paper market orchestration. Short sellers, who had been under extreme pressure during the rally, engineered a paper price collapse to exit their positions profitably. They sold paper contracts into a buyer-less panic, crashed the price, bought back their shorts at a massive discount, and closed their books. This was a transfer of paper positions, not a flight from physical metal. The trading screens depicted Armageddon. The vaults registered nothing but stillness. This leads us to the most revealing data point of all, the instantaneous fracture between paper and physical reality. When the COMEX exchange in New York closed on Friday, the official paper price for silver was settled at $84 per ounce. However, on that same Friday, the price to acquire actual, deliverable physical silver on the Shanghai exchange was 122s. In other Asian hubs like Tokyo, reports indicated physical premiums pushed real prices toward $150. This represents a 44% disconnect between the paper derivative price and the tangible asset price for the identical commodity on the identical day. Which price is the illusion and which reflects reality? Consider the pre-crash environment. For weeks, bullion dealers worldwide reported physical silver selling between $120 and $150 with inventories utterly depleted. If you're a dealer with empty shelves and a line of customers willing to pay $150, does a flashing number of $84 on a New York computer screen alter your selling price? It does not. The paper market flashed one number. The physical world operated on another. The 44% gap is not an anomaly. It is a symptom. The evidence of coordination deepens when we examine the calendar. The crash occurred on Friday, January 30th, the final trading day of the month. Now, rewind exactly 1 month to Tuesday, December 31st, also the final trading day of its respective month. What happened? Silver experienced a sudden, sharp 15% single-day drop before resuming its January rally. 2 consecutive month ends, 2 massive orchestrated sell-offs. The pattern is a signature. Now, connect the ancillary events. On December 31st, the Federal Reserve's standing repo facility extended a record-breaking amount of dollar liquidity to major banks, the highest single-day allocation ever. And what was the backdrop on January 30th? The U.S. government was hours from a shutdown, creating market-wide uncertainty and demand for cash. Here's the connection. The primary banks that are the largest holders of short positions in silver futures, data publicly available via the CFTC and CME, are the same prime dealers who access the Fed's repo facility. Month end is when these institutions face balance sheet and regulatory constraints. Month end is when they need to adjust positions and secure liquidity. Twice in a row, month end provided the cover and the catalyst for a targeted metal smash. December 31st, record repo, silver down 15%. January 30th, government chaos, silver down 40%. This is not a pattern of chance, this is a pattern of operation. The stage was further set by the Chicago Mercantile Exchange, CME, the central clearinghouse for precious metals futures. Their role was not passive. On December 12th, 6 weeks before the crash, as silver rallied powerfully, the CME quietly increased margin requirements by 10%. No fanfare. On December 29th, they hiked margins again by 25%. On December 30th, less than 24 hours later, they issued another increase. Then on January 28th, just 3 days before the climax, the CME changed its entire margin calculation system, effectively raising rates again. 4 distinct margin hikes in 6 weeks, culminating in an aggregate increase of roughly 80% in the capital required to maintain a futures position. For a leveraged trader, this is a death sentence. It forces the liquidation of positions not based on market direction, but on a sudden, insurmountable capital requirement. The CME manufactured the very forced selling it would later claim to be managing. But the most telling act occurred after the massacre. On Saturday, January 31st, with the market in ruins and volatility theoretically subsiding, the CME raised margin requirements yet again. This post-crash hike served not to stabilize, but to suppress any potential rebound, keeping immense pressure on leveraged players. True risk management following a collapse would involve easing conditions to allow orderly healing. This was the opposite. This was a boot remaining on the neck. This script is not new. It is a recurring playbook from modern financial history. Examine 1980. Silver rocketed from $6 to $50 per ounce. The Hunt brothers attempted to corner the market. The response? The CME created Silver Rule 7, banning new leveraged long positions overnight. The Federal Reserve under Paul Volcker jacked interest rates to 20%. Result, silver was crushed from $50 to $10, an 80% destruction. Fast forward to 2011. Silver surged from $8 to $48. Widespread retail participation returned. The response? The CME raised margin requirements 5 times in 9 days, an 84% increase. Result, silver collapsed from $48 to $26, a 50% loss that took over a decade to recover. Now 2026, silver soars from $26 to $121. The response, 4 margin hikes in 6 weeks, a contradictory Fed chair nomination, a key physical buyer stepping aside. Result, a 40% collapse in a single day, 1980, 2011, 2026, same tools, same timing relative to parabolic rallies, same outcome. Once is circumstance, twice is notable, 3 times is a documented policy of containment. This brings us to the ultimate hypocrisy and the most critical insight. While the paper price was being systematically dismantled and retail investors were being liquidated, guess what the world's central banks were doing? They were accumulating. Aggressively. In the year preceding this event, central banks globally purchased over 800 tons of gold, the fastest pace of accumulation in decades. The US dollar's share of global foreign exchange reserves has fallen to 58%, a multi-decade low. For the first time in the modern era, gold now comprises a larger share of central bank reserves than US Treasury securities. Let the magnitude of that statement settle. The institutions that manage the world's monetary system now place more trust in an inert metal than in the debt obligations and promise of the United States. They engineer a paper price collapse, then use their privileged position to acquire physical assets at the artificially depressed prices they created. The wealth transfer is breathtaking. From the panicked retail hands forced to sell paper derivatives, to the vaults of central banks and sovereign entities accumulating tangible metal. This is the silent truth behind the loud crash. I am speaking directly to you now. I understand the fear, the frustration, the betrayal you feel watching a decade's worth of conviction be attacked in an afternoon. You are wondering if you should cut your losses and exit. Recall the timeless market axiom: be fearful when others are greedy, and greedy when others are fearful. Days ago at $120 silver, greed was universal. Today, fear is all-consuming. This is not a recommendation to buy or sell, but a recognition of the psychological cycles that have governed markets for centuries. Those who capitulate at the point of maximum fear historically lock in their losses at the worst possible moment. The landscape is littered with the regret of those who sold the 1980 or 2011 lows just before long-term recoveries began. Your decision hinges on a fundamental question. Do you believe in the reality of the physical metal you own, or the illusion of the paper price they control? So we return to the pivotal question. If gold and silver are truly irrelevant, barbarous relics, if they pose no threat to the modern fiat system, why the relentless, coordinated, multi-continental effort to suppress them? Why time a Fed nomination for maximum impact? Why would China alter its behavior at the precise moment of crisis? Why hike margins 4 times before and once after a collapse? Why does a 44% chasm between paper and physical persist? Why do the crashes consistently align with month-end liquidity operations and banking needs? You do not marshal this level of institutional power to combat something insignificant. The ferocity of the attack is direct evidence of the potency of the target. They are not protecting market stability. They are protecting the dollar's hegemony. They are protecting the narrative of fiat currency supremacy. They are defending a system built on debt and confidence from a tangible alternative that operates outside that system. Gold at $10,000 and silver at $300 is not just a price prediction, it is a verdict. It declares the failure of decades of monetary debasement. That verdict cannot be allowed to manifest. So Itamen write scripts, they execute demolitions, they harvest the fear. You have now seen the full 72-hour script, the Tuesday signal, the Thursday euphoria, the Friday execution. You have seen the contradictory political moves. You have witnessed the strategic withdrawal of a key market participant. You have reviewed the data proving the crash was a paper-based position transfer, not a physical liquidation. You have seen the staggering disconnect between derivative and tangible value. You have recognized the month-end pattern tied to central bank liquidity facilities. You have observed the exchange's role in manufacturing the selling pressure. And you have reviewed the 50-year playbook that confirms this is established policy, not happenstance. They labeled it a crash. I label it the third act of a long-running defense of a fragile system. They call it volatility. I call it a 3-day financial special operation. They claim it is risk management. I call it the system revealing its true priorities. What they fear is simple, profound, and empowering. You holding real, non-counterparty, unprintable assets beyond the reach of their keyboards, their margin calls, and their monetary policy. That 44% gap between paper and physical is the system telling you where real value resides. Paper can be vaporized. Metal endures. 3 times in 50 years this script has run. 3 times after the dust settled, the physical metal not only recovered, but ultimately surpassed its previous nominal highs, affirming its enduring role. The question history poses is not if a recovery begins, but who will be positioned to benefit from it when it does. You now possess the information. You have seen the script exposed. What you do with this knowledge defines your path forward. Remember the emotion of this moment, the confusion, the silence from official channels, the scale of the vanishing wealth, and remember that you now understand what that silence was designed to obscure. It was never an accident. It was always by design. If this analysis has provided clarity, share it with one other person navigating this turmoil. One person contemplating a decision made in panic. One person who deserves to see the blueprint before they act. This is how we counter the narrative, with evidence, with logic, with unwavering focus on tangible truth. I want to know your stance. After everything revealed today, comment below. Are you holding or are you selling? I read every response. Subscribe if your priority is to see beyond the curated headlines, to understand the forces shaping your financial future. This is the reality behind the ticker. The script is exposed, the choice is yours.